A quiet shift is happening in the economy right now, and most people don't even realize it. Prices are going up almost everywhere, and yet something surprising is happening. Customers aren't pushing back the way they used to. No major outrage, no mass boycotts, no sudden drop in demand. Businesses are charging more, and customers aren't fighting, and that tells us something much bigger is going on beneath the surface. For years, the relationship between businesses and customers was simple. Companies tried to keep prices competitive, and customers constantly searched for better deals. If prices went up too fast, demand would drop. That balance kept things in check. But in 2026, that balance is starting to look very different. One of the biggest reasons is that price increases are no longer shocking. Over the past few years, consumers have been exposed to constant inflation, rising costs, and changing price tags. What once felt unacceptable now feels normal. When prices go up again today, it doesn't trigger the same reaction because people have already adjusted their expectations. This shift in expectations is powerful. It means businesses don't face the same resistance they used to. Instead of customers asking, "Why is this more expensive?" many are now asking, "Is this still worth it?" That's a very different mindset. It's no longer about finding the cheapest option, but about deciding what's still acceptable to pay for. At the same time, companies have become much smarter about how they raise prices. They're not just increasing numbers randomly. They're using data, behavior patterns, and customer insights to understand exactly how far they can go without losing demand. This is not guesswork anymore. It's calculated. For example, instead of raising prices across the board, businesses are targeting specific areas. They might increase prices on premium products where customers are less sensitive, or they might introduce smaller price hikes spread over time so it feels less noticeable. Sometimes they don't raise the price directly at all. They reduce the size, limit features, or bundle products differently. The result is the same. Customers end up paying more. Another reason customers aren't pushing back is because alternatives are becoming less attractive. In many industries, competition has consolidated. There are fewer truly cheaper options, and switching doesn't always lead to meaningful savings. When everything is expensive, nothing feels unusually expensive. This is especially true in sectors like streaming, software subscriptions, travel, and even everyday retail. Prices are rising across the board, so consumers aren't reacting to one company, they're adjusting to the entire market. There's also a psychological factor at play. After years of economic uncertainty, many consumers have shifted their priorities. Convenience, reliability, and familiarity are becoming more important than price alone. People are more willing to pay extra to avoid hassle or risk. That means businesses that deliver consistency can raise prices without losing customers. Another important shift is how spending habits have changed. Consumers are cutting back in some areas, but not everywhere. Instead of reducing all spending, they're becoming selective. They might cancel one subscription but keep another. They might eat out less often but still choose higher-priced options when they do. This selective behavior allows businesses in certain categories to continue raising prices without facing resistance. Businesses have noticed this pattern, and they're adjusting their strategies around it. Instead of trying to attract everyone, many companies are focusing on customers who are willing to pay more. This shift toward higher-value customers allows them to increase prices while maintaining revenue, even if overall volume doesn't grow as much. There's also a deeper structural change happening. Costs for businesses have genuinely increased. Labor, energy, supply chains, and technology investments are all more expensive than they were a few years ago. In many cases, companies aren't just raising prices to increase profits, they're doing it to maintain margins. And customers, whether consciously or not, seem to understand that reality. But here's where it gets interesting. The lack of pushback doesn't necessarily mean customers are comfortable. It often means they feel they don't have much choice. This is what makes the current situation different from the past. Instead of resisting price increases, many consumers are quietly adapting to them. That adaptation can take different forms. Some people downgrade products, others delay purchases. Some reduce frequency instead of abandoning a service entirely. These subtle changes don't show up as dramatic resistance, but they still affect how the market behaves over time. For businesses, this creates both an opportunity and a risk. The opportunity is obvious. Higher prices can lead to stronger margins and more stable revenue. But the risk is that pushing too far could eventually trigger delayed reactions. Customers might tolerate increases for a while, but if the perceived value drops too much, behavior can shift quickly. This is why many companies are carefully managing the balance between price and value. It's no longer just about how much they charge, but how they justify it. Branding, experience, quality, and convenience all play a role in making higher prices feel acceptable. Another key factor is transparency. Some businesses are openly explaining why prices are rising, pointing to higher costs or investments in quality. Others are more subtle, focusing on enhancing perceived value rather than addressing price directly. Both approaches are aimed at the same goal, keeping customers from feeling like they're losing out. Technology is also playing a role in this shift. Dynamic pricing, personalized offers, and real-time data allow businesses to adjust prices more precisely than ever before. Two customers might not even see the same price for the same product. This level of control makes it easier for companies to maximize revenue without triggering widespread backlash. At the same time, loyalty programs and ecosystems are locking customers in. When people are already invested in a brand through rewards, subscriptions, or integrated services, they're less likely to leave, even if prices go up. This reduces sensitivity to price increases and gives businesses more flexibility. So what we're seeing is not just a moment where prices are rising, it's a broader shift in how pricing works. Businesses are becoming more strategic, more data-driven, and more confident in their ability to charge more. And customers, whether by choice or necessity, are adapting to that reality. But this raises a bigger question about the future. If businesses can keep raising prices without strong resistance, where does it stop? The answer likely depends on how long customers can continue adjusting without reaching a breaking point. Because even though customers aren't fighting right now, that doesn't mean they won't. It just means the reaction is slower, quieter, and more complex than it used to be. In the end, businesses are charging more, and customers aren't fighting isn't just about pricing. It's about a fundamental change in the relationship between companies and consumers. A shift where expectations have reset, behavior has adapted, and the old rules don't apply the same way anymore. And as this trend continues, it could redefine how value is perceived, how competition works, and how businesses grow in the years ahead.